$10.4 billion in rent. That's what McDonald's collected last year from its own franchisees. It's the single biggest revenue line in the company, 1.7 times what the brand earns in royalties, more than most real estate trusts collect from anything. You think it's a burger chain? You'd be wrong. McDonald's is a landlord with tens of thousands of tenants, and the burgers exist so the tenants can make rent. Undervalued. The business they don't teach you. Start in 1954. Ray Kroc franchises the McDonald Brothers burger system out of San Bernardino and signs a contract capping his service fee at 1.9% of sales, half a point of which goes straight back to the brothers. Per John Love's Behind the Arches, that deal left the company nearly profitless. Kroc was building the fastest-growing restaurant franchise in America and could barely cover payroll. Not ideal. Then in 1955, he hired Harry Sonneborn, a finance executive from Tasty Freeze. Sonneborn looked past the burgers, past the fee, and found the real business sitting directly underneath the restaurants. Literally underneath. In 1956, Sonneborn created Franchise Realty Corporation. The model: McDonald's finds the site, buys the land, or signs a long-term lease on it, then subleases it to the franchisee at a markup. Rent is set as the greater of a fixed minimum or a percentage of the store's sales, so corporate gets paid whether the restaurant booms or merely exists. And the lease came with teeth. Love documents the design as deliberate. Break McDonald's operating standards and you don't just lose a contract, you lose the building. Love calls Franchise Realty the company's real money-making engine. If you like watching a lease do this much heavy lifting, you're in the right place. Here's what the engine earns now. Open the current 10K and franchised revenue splits into 3 lines. Initial fees from new franchisees, $88 million. Royalties, the brand fee everyone assumes is the whole business, $6 billion. And rent, $10.4 billion. The rent line is 1.7 times the royalty line and 39% of McDonald's entire corporate revenue, burgers, coffee, and everything else included. No other line item comes close, and the revenue mix is only half of what makes this model ridiculous. The margins are the other half. First, what the arrangement costs the person actually running the restaurant. Compute it from the 10K's own tables, and rent ran 11.1% of conventional franchisees' sales last year, 11.3% the year before. The royalty rides on top at 4% of sales, raised to 5% for new US and Canadian franchisees in 2024, the first increase in almost 30 years. And by most FDD analyses, an operator hands McDonald's 16 to 20% of gross before buying a single bun or hiring a single employee. McDonald's calls these operators partners. Partners don't usually charge each other rent. Now here's why corporate prefers landlording to cooking. McDonald's still operates about 2,000 restaurants itself, which lets us compare the two businesses side by side. Company-operated stores turned $9.7 billion of sales into $1.4 billion of margin. 14.7%. Normal, respectable restaurant economics. The franchised side turned $16.5 billion of rent and royalties into $13.9 billion of margin. 84.2%. Same arches, same menu, same fries. One version of this company keeps 15 cents of every dollar. The other keeps 84. Franchising delivers roughly 91% of McDonald's restaurant margin dollars. Selling burgers is the demo unit. Renting to people who sell burgers is the product. So what does the landlord actually hold? The balance sheet itemizes it. $8.2 billion of land at cost, $22.2 billion of buildings on land it owns, plus $15.5 billion of buildings on land it leases, $49.3 billion of property at gross cost, and per the 10K, $22.8 billion of it, net, sits under franchise arrangements, rented out. Here's the quiet part. That land is carried at whatever McDonald's paid for it, and a lot of it was prime suburban corners bought with 1960s and 70s money. The book says $8 billion. The book hasn't been outside in 50 years, and the leases on that property are where this gets genuinely strange. McDonald's has $31.5 billion of future minimum rent already locked into signed franchise agreements, contractual, guaranteed, before percentage rent even kicks in. And roughly half of it comes from sites McDonald's doesn't own at all. It collects rent on land it bought. It collects rent on buildings it built. And it collects rent, marked up, on land it's merely renting from somebody else. Its own rent bill last year was $1.6 billion, against $10.4 billion collected. Pay $1.6, collect $10.4. Keep the difference, plus the power to evict anyone who breaks standards. This is the biggest hidden machine we've covered on this channel. If that's what you're here for, subscribe. One company a week, taken apart exactly like this. Wall Street ran these numbers too. In 2015, Glenview Capital, then a top 25 holder, publicly pushed McDonald's to spin its property into a REIT, claiming per Forbes it could unlock at least $20 billion of value. McDonald's refused. Its statement said any value from a REIT was, quote, outweighed by the significant financial and operational risks to our business. Translation: the landlord and the brand are one weapon, and splitting them dulls both. Weeks later, Congress passed the PATH Act and killed tax-free REIT spin-offs anyway. McDonald's kept the buildings, added debt, and returned about $30 billion to shareholders through its 2014-16 program instead. The stock appears to have coped, which doesn't make the model bulletproof. Now the honest counterweight, because this story earns it. McDonald's isn't diversified real estate. Every tenant sells the same menu out of a building designed for exactly one use, and the rent is a percentage of burger sales. If the burgers stop selling, the landlord stops collecting. The model is also financed. The 10K lists $15.6 billion of foreign currency denominated debt alone, and the balance sheet has shown negative shareholders' equity for years. And that famous 84% margin bundles rent, royalty, and brand into a single number. It's not a pure real estate return. The real estate is the structure. The demand is still a hamburger, which is exactly how the man who designed the whole thing described it. Per John Love's Behind the Arches, Harry Sonneborn reportedly told Wall Street investors, "We are not technically in the food business, we are in the real estate business. The only reason we sell 15-cent hamburgers is because they are the greatest producer of revenue, from which our tenants can pay us our rent." That was the pitch in the 1950s. Last year, the rent line hit $10.4 billion. He wasn't making a quip, he was reading the blueprint out loud. So, the callback. McDonald's isn't a burger chain that happens to own property. It's a property company whose anchor tenant sells burgers, and $10.4 billion of annual rent says so. Here's my question for the comments, and I actually want answers. What's another company whose real business is hiding in plain sight on its balance sheet? Drop it below, it might become an episode. Next week, Ryan Reynolds. How one actor flipped a gin brand and a budget phone carrier into roughly $2 billion of exits using nothing but marketing.